So I looked up what it would cost for a couple age 62 living in Connecticut in my area with a modified adjusted gross income of $70,000. And the second cheapest silver plan would be $23.27 a month. So quite a lot of money. On an annual basis, that would be $27,924. So if you then take 8.5% of that $70,000 of modified adjusted gross income, that gives you $5,950.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This week I'm going to talk about something that just happened a few weeks ago, and that is the American Rescue Plan and certain provisions in it that apply to health insurance and how you can obtain coverage. If you're not aware, the American Rescue Plan was passed on March 11th. It's predominantly designed to help continue to give people aid who are affected by COVID, as well as helping give money to states as well to balance their budgets and pay for other things. But there are some changes that are impacting how you can get health insurance coverage before age 65. And if you haven't listened to episode 18, that is health insurance coverage before 65, then you should go back and listen to it after you listen to this, because this is building upon some of those options that are available to you. And if these things apply to you that I'm going to talk about, then there's a reason, I should say, to begin this rather quickly, because the sooner you take advantage of these options, the sooner that you actually will receive the benefits from them. So I'm going to cover 4 new opportunities for health insurance before age 65. And the first is that you may be aware that you're eligible for a health insurance subsidy, and there is now an enhanced health insurance subsidy that you could be available to. So prior to this act being passed, you were eligible potentially for a premium tax credit based on your family size and based on the number of dependents that you have. There'd be a number that was determined that corresponded to a limit that your modified adjusted gross income could go up to before you would lose this subsidy. So this, if you're curious how this is factored in, well, every year the federal government releases the federal poverty level, and the numbers that I'm going to talk about are 400% of that amount. So for example, for a single person for this year, your modified adjusted gross income is limited to $51,520. For a married couple, your modified adjusted gross income is limited to $69,680. And every dependent that you add on from there then raises this limit. For example, a family of 4 is limited to $106,000. Prior to this act, if your modified adjusted gross income went $1 over this limit, then you lost your subsidy. And this was quite a significant cliff, you could say. If you were receiving the subsidy, obviously you didn't want to lose it, so you had to really keep a good eye on what your modified adjusted gross income would be. If you're retired, it's a little easier to project, but if you're working and you weren't sure how much you'd earn for the year, it could be quite challenging. Certain things you could do to actually reduce that is that you could put more into qualified retirement plans, because again, it is your modified adjusted gross income, which is, all earned income as well as retirement account distributions. There are some other things that go into that. So now, however, there's actually not a cliff anymore. And if you happen to go over that limit, you still don't lose your benefit, because now what's happening for 2021 and 22, if your premiums that you pay are over 8.5% of your modified adjusted gross income, then you will still qualify for the subsidy. So even though you might not get the full subsidy, you still can get something. And so this credit is based on the cost of the second cheapest silver plan available in your area. If you're not aware that all these plans have metal codes or labels, you could say, they're silver, bronze, and gold. So for the second cheapest silver plan in your area, this credit would be based off of that. So if you're not sure what that is, they suggest going to healthcare.gov, and once you go to that website on the homepage, if you click take the first step to apply, I believe it's a big green button, and then you scroll down and select your state. It will then either have you continue on, or if your state has its own exchange, then you will be directed there. There's a number of states that have their own exchange that don't use the federal government's exchange. Where I'm located in Connecticut, Connecticut has its own exchange. It's accesshealthct.com. So I looked up what it would cost for a couple age 62 living in Connecticut in my area with a modified adjusted gross income of $70,000. And the second cheapest silver plan would be $23.27 a month. So quite a lot of money. On an annual basis, that would be $27,924. So if you then take 8.5% of that $70,000 of modified adjusted gross income, that gives you $5,950. So that would be the maximum that this couple would be expected to pay on an annual basis. So they're essentially getting a tax credit of $21,974 to help pay for their health insurance premiums. That's the difference between the cost of the silver plan minus 8.5% of their adjusted gross income. So this is still quite a savings. And the more that you make, obviously, the more that your subsidy is phased out because, you just keep growing your adjusted gross income or modified adjusted gross income, and you multiply that by 8.5% to figure out where it would be phased out. And in this instance, for this couple, that would be phased out with a modified adjusted gross income of $328,000. So your income could go pretty high until this would be phased out. And the healthcare.gov website is supposed to be updated by April 1st to reflect these new tax credits. And open enrollment is being extended until May 15th. So you want to act fast to make sure that you can take advantage of this. Now, I reached out to the Access Health CT folks who manage the plan in Connecticut, and they didn't have an answer for me as to when their website will update these changes. So you might want to wait a week or two to apply and take advantage of this. And then I'll share a link as well that there's another calculator I found where it will also allow you to play around with your income and what the size of your family is, as well as what your home state is, to give you an idea of what the cost might be that you're paying. And for now, this tax credit is only going to last for 2 years, but it could be extended beyond that. And if you're already on a plan through the Affordable Care Act, then you might want to reevaluate your plan to see if you qualify for lower cost sharing. You could either reach out to your state health insurance website provider, if it's healthcare.gov, or you probably want to find a health insurance broker who can help you with that. So next is there's assistance to limit the amount that you have to pay out of pocket for unemployment or for health insurance if you qualify for unemployment. And so this is for anyone who receives 1 week of unemployment benefits in 2021. They will be deemed as having earnings at no higher than 133% the federal poverty level for the entire year, and will therefore qualify for a no premium silver plan. So this means that if this applies to you and you qualify, you don't have to pay anything for a silver plan. Now, obviously, I talked before about these plans having deductibles, and all the plans do, and they're not, even the most expensive premium plans have fairly high deductibles. So because of this, you're being deemed as only having income at 133% the federal poverty level. There is a cost sharing as well that applies to the deductible. So typically for someone who has 250% federal poverty level, which is a higher amount, the deductible will be about $5,000. So it keeps going down from there. So at 133%, chances are you will have very little, if any, deductible. And from what I read, this will not be reflected in time by healthcare.gov. The Connecticut plan also didn't have an answer for me on when this will be in effect. So you might not see this change until like late summer, maybe fall. And so if you're owed this money, you'll probably have to wait until you file your taxes to get this money back. However, if you just lost your job and you're collecting unemployment, then you could actually use 133% of the federal poverty level as your projected income for the year, because when you go on these plans and get these subsidies, they ask you to project out what your income is, and then they determine how much you pay. So you could do that, use a low amount, and then you'd qualify for this very low deductible. And then you just have to keep an eye on to seeing what happens later down the road and how this could impact you. Next change is that there's a change in the Cobra premium assistance. So you may or may not be aware, but when you lose your job, you have an option, if you had employer health insurance through your plan, to continue that through what's known as Cobra. And normally you pay a certain percentage of the premium. I think it's 102%. and then your employer pays the rest for the first 15 months, and then you pay the full cost for the remaining 3 months. So if you have lost your employer-based health coverage due to a job loss or reduction in hours, then the American Rescue Plan will provide for premium subsidies for your Cobra insurance between April 1st and September 30th. So this could be very helpful. However, after September 30th, you would then pay the full cost of your Cobra health insurance. So if you don't think you'll have another job by September 30th, then you might want to go on the exchange and get the free silver plan, as I mentioned before, because you have very little, if any, deductible, and it's going to cost you nothing out of pocket. Because the problem is what happens after your subsidy runs out. The benefits of staying with the Cobra plan, however, are that if you've already met your deductible for the year, then you can continue with your plan for the remainder of the year. So you really just have to pay for the remaining 3 months of the year. So that might be better than going with the silver plan, as well as you're not having to change plans and, figure out a new system. But it is something that could benefit you. The fourth way is really pertaining to whether or not you had a premium tax credit for 2020. So there's forgiveness of excess premium tax credit repayment. Let's just say you were on an affordable care plan in 2020. You were projecting to have your modified adjusted gross income over whatever was the applicable threshold, and somehow you went over that, right? You had extra income, you didn't really project it out well, and normally what would happen is that now you have to repay that money when you file your tax return. But for 2020, they've decided that that doesn't need to be repaid. So it could be a major savings to you. And I had this happen to one client recently. However, the IRS has not updated their paperwork. And if this applies to you, then you want to wait to file your tax return until this is updated. So I spoke to an accountant even just a couple days ago, and they still hadn't updated how to handle this. And if you've already filed and you've paid back this money that you thought you owed, then the IRS has said to hold off filing an amended return and just wait to see the guidance they'll release on the coronavirus tax relief website. So definitely some positive changes here. I guess last thing to think about is, what does the future look like for the Affordable Care Act? What are your options if you're a ways off from retiring? Well, you kind of have to wait and see. I mean, we know this is going to be beneficial if you happen to be retiring this year and you're 63. Well, this is one way that you can get yourself potentially to age 65, which is the magic age for health insurance, because at that point you can go on Medicare, and it's a lot less expensive for most people to go on Medicare than it is to self-insure. But maybe this will continue, and this could be a way that you could retire even before then, in your early 60s, even in your 50s, and be able to qualify for this premium. So definitely, if you're not qualifying for this, then reach back out to your health insurance broker, to one of the affordable care exchanges, to figure out if you could qualify for this. And maybe at some point these things will be permanent, so we won't have to really, wait for the most recent iteration or change, with these plans. So I hope you found this episode beneficial. And if you're enjoying these podcasts, I really would appreciate a review being left on Apple Podcasts. Go to Apple, open up your Apple Podcast app that you're listening to this, and leave me a 5-star review, as also a couple words about what you like about the podcast or how it's benefited you would be very appreciative. And if you haven't subscribed, please open up your phone as well. If you're listening to these through my weekly email that goes out, subscribe through your Apple Podcast, search Retire with Ryan, click subscribe, and that way you'll get these podcasts as soon as they're released, which is every Wednesday morning. Hope that you have a great week, and I look forward to talking to you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.